But really, with interest rates climbing, your cap rates have to climb with it. Because if you have a lower cap rate than an interest rate, then you're asking for trouble or you are have a horrible loan.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting.
Hey everybody, welcome back to the Ironclad Underwriting Podcast. In the last episode, we went through the NOI, our net operating income, and the calculations for how to figure it out from there. If you need to recap or refresh your memory, go back to the last episode and listen, because this episode we're building up on the NOI and moving on. So again, I got special guest Frank Patalano here.
Hello, sir.
And you have anything before we begin?
No, I'm very excited what we're going to talk about today. This really helps people understand pricing.
Yep. So in the last episode, like I mentioned, we went over the net operating income, or NOI. So what does that mean? This is probably the most important number of underwriting or of a property, because it tells you the strength of it, the financial strength of the property, how much your income is minus your expenses. And then this is also how basically you get your valuation of a property. So what every market has, and this is a new term, is something called a cap rate or capitalization rate. And what the cap rate is basically what it would be if you bought the property outright. Say you buy a $10 million property and its NOI is $1 million every month or every year. Your cap rate would be, all right, well, if I buy it for 10 million, I bring in 1 million every year, it'll basically pay for itself in 10 years. So that would be a 10% cap rate. You have 1 million annual income over your purchase price, 10 million. So that would be your cap rate. Now, generally, you don't buy properties outright, or at least I don't. A lot of times I'll take out a loan, use leverage to help boost my returns. And we'll get into leverage and debt structures later. But right now we're just talking about cap rate and NOI and valuation. So if you're in a market with say a 10% cap rate, one, you're not in a very good market. It's a very risky market. Generally speaking, the higher the cap rate, the riskier the investment. So a lot of times you might find properties that are trading at like 12, 15% cap rate. It also depends on your asset class too. Self-storage can sometimes have a higher cap rate, especially like your Class C self-storage. But generally, the lower the class property, also the higher the cap rate. So, and your market dictates it. So you might have a Class A property in New York City. Your cap rate you can be expecting that to be would be, what do you think, Frank? 1 to 2% Class A in New York City?
Yeah, I know more about Boston. Boston, I saw stuff when interest rates were lower. I saw cap rates at 2.5 to 3%.
Yeah. If you're in a secondary market, you can expect cap rates to be, say, for a Class A property, maybe in the 4.5. For a Class C, you can expect going up to like into the 6% or so. And also cap rates vary per year. as well. It varies based on what's trading in your market, what the interest rates are doing, because that dictates what things are trading at. Um, what else affects cap rate? So you have your class of your property, you have your market, you have interest rates,
On the age of the property.
age of the property. Age and class sort of go hand in hand a lot of times.
That's true. There's also the cost of the neighborhood,
Yeah.
you know. So I mean, when you think of cap rate, it's like basically what's the risk factor or what type of return based on your risk do you want to get for your money? So,
Yeah.
I mean, a lot of markets that I'm looking at are usually like a 6 cap to a 7 cap. There are definitely riskier areas that you would expect a higher return.
Yeah. And a few years ago, those same markets were in low 5 cap, right out of 5. Now they're just sitting at mid 6s. And that is really mainly due to interest rate fluctuation. 5 years ago, interest rates were in the ones and twos. Now they're in the 6s. So, um, and I did a comparison of what it would take to get, and this is going into the weeds, but with interest rates and cap rates, what it would take to get a DSCR of 1.4. DSCR is debt service coverage ratio, and we'll get more into the debt side of things. But really, what this is your debt service or your NOI. Again, the main um, the main variable we have to pay attention to over your debt service every year, and then that would be your debt service coverage ratio. Um, I should have pulled this up before. Actually, I won't pull it up now. But really, with interest rates climbing, your cap rates have to climb with it, because if you have a lower cap rate than an interest rate, then you're asking for trouble, or you are have a horrible loan. Um, you might be, you wouldn't be able to cover your debt service coverage ratio potentially, and so you would have to have like a higher or a lower LTV or loan to value. So you might have to put up like 50% as opposed to say 30%. So, um, and that's cap rate with interest rates. You have anything else to say on that, Frank?
I'm just thinking about, if when they raise interest rates, if I can get a decent return at a bank, and obviously the word decent could mean a lot of things, but if you have a bank that's paying you 4%, obviously I would want to get a better return on my real estate investments because there's a lot more risk involved.
Yeah.
So when interest rates go up, you would expect automatically for cap rates to go up as well.
Yeah. And so I sort of briefly touched about how to calculate the cap rate based on the NOI and the value of the property or the purchase price. But that cap rate, as I said, is like market dependent, class dependent. And so that is almost like your fixed variable. And so you can get your valuation from that based on your NOI. Suppose you have an NOI of, let's go with the previous one. We had 660,000 NOI. And let's say this is in a market with say 6.5 cap rate. I'm doing some calculations of.
So you're doing 660,000 divided by 0.065.
Correct.
Just for people in the audience.
So, and let's see. So what is that? That is
10.1. 5.
so yeah, that's 10.15 million. So that would be what you would estimate your value to be. And we were talking about like a $10 million property in the last time. So this is actually not too far off at a 6.5 cap. Let's see. And another thing is with this 6.5 cap, which is more or less fixed, what you can do is a thing called value add. So there's two types of appreciation in the real estate world. Residential is basically uses one called natural appreciation. It's your property is dependent on your neighbors. You can have like the best stuff inside, best appliances, best flooring, best paint job, everything. It doesn't really matter because what your neighbors have in your whole neighborhood, that really dictates the value of your property.
Yeah, you
With
sales comps.
sales comps. With commercial property, everything is dictated by the NOI. So remember, the NOI is revenue minus expenses. So if you can increase revenue or decrease expenses for both, your NOI really can go up. And suppose we took rent from, say, suppose we increased rent on a 100-unit property, $100 on average, or let's just say $25 on average.
Yeah, I was using $50 a month as an increase.
Okay,
If you're $1,000 if you're $1,000 a month in current rent, that's a 5% increase in rent.
yeah, so we increase it $50 a month on 100 units. That's what, $5,000
Yep, times 12 months,
times 12,
60,000.
60,000. So if we do that, 60,000, and this is only increasing rents by $50 a month.
Yep.
So we take that 60,000, divided by your cap rate. What you ended up doing is increasing the value of the property almost $1 million, $923,000, just by increasing the rent $50 per unit on average. So this is the other type of appreciation called forced appreciation. And so if we can force appreciate it, we can increase our NOI, then we really increase the value of the property. Let's see.
I like
That's and that is for a $50 a month increase. That's a $60,000 increase in NOI. So if you can decrease your expenses by 30,000 and you can increase your revenue by 30,000, that's still the same 60,000 increase in NOI. So
depending on the market, it's probably a lot easier to increase rents than decrease expenses. Historically, over the past few years, we'll see what's happening now. I know that there's many places where rents have stalled the increases, so it might be a little tougher right now.
yeah. So if we were able to increase 65,000 instead of 60, that would have been a flat $1 million increase in value. So we went from a $10 million property to $11 million property without really doing anything. And this would be just like when you first take over a property and get all the leases in. If you're going to be holding this for say 5 years and you're increasing your rents 5% every year, then this is where your value add play comes in. This is where you're going to end up making your money. And we'll deep dive into that later with exit plans and stuff like that. But right now, we just wanted to wrap your mind around with the idea of cap rate and how to use it for evaluation of the property and how you can increase the value of a commercial property by using the cap rate and the NOI. Have anything else, Frank?
Well, I'm just thinking of the concept here. I mean, it's all property specific. There are some deals where the owners owned it for a long time and they have not raised rents at all. So $50 without doing much might not be anything. But back to your concept of $100 or even more, I mean, you might decide to do a full value add play where you're adding new floors and you're upgrading the kitchen a little bit, maybe some new appliances. You might average a capex of $6,000 a unit, but you might be able to raise the price of the rent by $200 a month.
Yeah.
I mean,
And
that's where the real
that's where the real heavy value add play comes in, where you can take a really bad C class property or maybe even a D class, and you bring it up to a say, you there?
Yeah, I'm still here.
Okay, my headset just cut out. So you take a C class property and bring it up to a B minus or a B, or you take a D class and you bring it up to a C, maybe even a C plus. That's where your heavy value add play is, but that's also where all the risk is too. If you're in a small town like where I invest in, you could have a property that's been there since the 60s. Everybody knows about it. Everybody's heard the horror stories about it. You come in and say, well, I'm going to do this. I'm going to change everything. I'm going to invest 2.5 million into this property to really bring it up to today's standards. But it still has a stigma. And so it's still going to be really hard to get people to come in and rent. Or if they do, it's going to be hard for them to pay the rents that you want to achieve.
So I'd argue with you that I don't consider the numbers that we were just discussing a heavy value add.
What you said, no, I wouldn't consider that a heavy value
Yeah.
add. It's 6,000 a unit.
Yeah.
Um,
We
I'm
did one. We did one recently. It was 68 units, where we put about $1 million of capex into the property.
Yeah.
And so about what's $1 million divided by 68?
14,000.
Yeah, I was going to say we average about $15,000 a unit.
Yeah.
And the market rents were so high. The guy had owned them for over a decade, and I don't think on most units he raised it once. So I mean, we averaged a $500 increase per unit, and the property was still way under market. I mean, many people stayed because when they looked around, they said, "Wow, this is still a great deal," and we did upgrades.
So when you're that far below the market, a lot of times you don't even have to do any upgrades. You can just increase it. Say, if you're 500 below market, you increase it to 50. You don't even have to do the upgrades, and you're going to get halfway there without doing anything.
So I know this is different in North Texas than in other parts of the country. Some of these units were $1,000 below market.
Wow.
So we did some fix up and we brought up some rents.
So, but if you do the renovations and everything, then you can actually go up to like what should be your market comps and not just, all right, I'm going to increase rent because I can without doing anything. So,
yeah, it's always nice if you can provide reasons why tenants would want to pay more besides just saying, well, the market's changed. In some ways we're providing a service. We're housing providers in many ways. So if you can give them, even if it's small things, a new refrigerator and maybe a ceiling fan, stuff like that.
yeah. And that's true is your residents are basically your customers or your clients, and you need to treat them well. You need to give them a reason why you feel you can justify these rents. Because if you can't or don't, they'll leave. And even external market things that go on in the market will affect people leaving. And so you really, and like times like right now, it's trying to hold on to every resident you can, or at least we are. One of our properties is doing really well, sitting at like almost 100% every month for last year. But our other property, we saw the exact opposite, and we're doing everything we can to get it to be stabilized. So yeah, do value add so that you can increase rents, have justification to increase rents so that you have happy residents. Happy residents equals happy checkbook generally. So anything else?
Not on cap rate right now. I mean, one of the things you could think about is, like you said, it's market specific and everything else. What's the best way to determine the cap rate, in your opinion, in a market?
So I use a cap rate as just like a quick calculation on what a property should be worth. But ultimately what it boils down to is if I put a property into my underwriting model, I don't even look at the cap rate until like the end. I want to see what the return metrics are, and we're going to get into these in a later episode. What the return metrics are, will my investors want those return metrics? And what little tweaks I can do to increase it. And this is where your cap rate comes in. So, but ultimately, I get my purchase price of what I'm willing to offer on the property from my model, based on the return metrics, based on like say cash on cash, your IRR and AAR and all that, which we'll get into in a later episode, are all sort of dictated by the cap rate, the exit cap rate, which we didn't even talk about. And so when you have that dictated by a cap rate based on your incoming and exit, then that's where your cap rate comes into play. And while we're here on cap rate, there's exit cap rate, which is a cap rate you expect to leave or sell your property at the end of, say, 5 years, 7 years, 10 years, if you're going to hold it for a long time. And generally speaking, you do not want to see cap rate compression, or you don't want to see the cap rate get smaller over the years. I mean, there's a caveat to that. You don't want to model the cap rate getting smaller over the years. If it does get smaller, that's even better for you. But you cannot assume that it's going to get smaller. You have to assume it's going to grow. Because remember, you buy a 30-year-old property today, at the end of 5 years or 10 years, it's going to be a 35 or 40-year-old property. And so that 40-year-old property is going to have 40-year-old property issues. You're going to have plumbing, you're going to have roofing, you're going to have cracks in the sidewalls and everything else. You're going to have all of these things associated with a 40-year-old property. And so that's going to bring the cap rate up. So
Jason, one of the things that we should mention here is that when you purchase something, the cap rate at purchase is just what the cap rate was at purchase.
Yeah.
And then things change beyond that as you're underwriting as a possible exit strategy. Number one, you're assuming what the cap rate's going to be, but everything in the end has to do with whatever a buyer and a seller can agree on.
correct.
Your cap rate does not follow you throughout or anything else. You don't really change the cap rate throughout because you're not selling the property. Your cap rate is based on your NOI and your purchase price.
Correct.
And then you're using that to assume on the flip side.
Yeah. So, and if you're in a market that has like a lot of properties that are changing hands, people are buying and selling properties, then you can use those comps from their cap rates. So suppose someone buys a property down the street at a 5 cap, or they buy another one up the street at 4.5 or whatever. You can probably take an average or so of all of those to at least get a roundabout figure what your cap rate should be for your property. But if you're in a market where nothing's trading, then it's going to be difficult, and you're going to end up having ranges like, well, this could be a value from, say, a 5.75 up to a 7.25 cap rate. So it could be anywhere from, say, a $10 million property up to a $15 million property type. So, I mean, it's hard to get a good valuation when nothing's trading. and it's super easy to get your head wrapped around cap rate, because ultimately you want to know, if I buy it at this much, if my expense ratio is this, if my NOI is this, and my debt service is this, will I make money? And that has nothing to do with cap rate. It's like, all right, well, I will adjust my purchase price down so that I can at least make the debt service and make it a wash. If I decrease my purchase price even more, then I get a little bit extra cash flow type thing. And then at the end of all of that, you can see, all right, the NOI is this is my offer price. So then you can go back and calculate your cap rate from there. So
I would say having a good conversation with a couple commercial brokers in your local market would help see what they think the cap rate or what things are trading for.
and that's what they'll give you a range. They'll say, all right, if it's trading at 5.75, it's this. If it's trading at 7.25, it's this. We estimate it's going to be 6.65, and it's going to be, we estimate that, but it could be anywhere in between, and that's what they'll tell you.
Yep.
So, so that was cap rate and valuations and how convoluted it is and why you shouldn't just strictly use cap rate, because you can pretty much make up whatever numbers you want. And catch us next time, and we'll go over some more key terms and how they're used in calculating the performance of a property. So, you have anything else to add, Frank?
Nope.
Nope, I don't have anything else. So, again, this is Ironclad Underwriting Podcast, and we'll catch you next time. Bye.
And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.